The Federal Reserve met this month and once again opted not to reduce the federal funds rate, keeping it steady now for 12 months in a row. 2024 seems so hopeful at the beginning of the year. So much for that. Why is the mortgage rate not dropping significantly if inflation numbers came down? Let's find out. This is Celina Acosta, your Phoenix real estate advisor, here with your June 2024. It's the halfway point of the year housing update for Phoenix, Arizona, and the metropolitan area coming up. The Consumer Price Index was released, showing the annual inflation rate declined to 3.3%. This resulted in conventional mortgage rates dropping from the average of 7.16% to 6.98%. Not very exciting, but hey, a win is a win. While this small drop is positive news for buyers, the rate is still too high to expect any major boost in demand at this stage. The bottom line is that inflation is still too high. It only came down a tiny little bit from 3.5 to 3.3%, so that's still relatively high because they want to see 2%. It is going to take longer for rates to come down, especially a significant drop. The Fed announced, however, they anticipate one rate cut this year, possibly in September. Frankly, at this point, I don't believe anything. But we will see. It is an election year. If we do have a drop in rates in September, it won't be for too much, so don't get too excited. Experts predict a quarter of a point, if that. Comment below if you think the rate will drop and for how much. And I just said it's going to take a huge drop in interest rates to make any difference in demand. Demand is still sluggish and supply is 54% higher than last year. So this is creating a very interesting environment for buyers that hasn't been this accommodating in the last 10 years. Take advantage of it because accommodating markets don't come along that often in Phoenix. The prices on the rate may seem high, but this type of markets is where you can negotiate and get better terms. Slightly better prices, repairs, more concessions, rate buydowns, less competition, etc. Yes, price negotiations are ramping up, but they look different depending on the price range. So the lower bracket, let's take the $300,000 to $500,000 price point. This price point is still closing at 98.7% of the asking price, down from 99% of last year. So still closing very close to asking price. However, in this price point, the majority of buyers are more sensitive to their monthly cash flow, more than the final sales price. Therefore, 55% of sales that closed in this price point in the last 30 days had seller incentives, so cash that was given to the buyer to cover their closing costs or buy down the rate. Buyers over $1 million are less influenced by mortgage rates and concessions and prefer to negotiate the price directly. Price negotiations so far this June are closing at 95% of list price, down from 96.4% of last year and 96.1% last month. On $1 million purchase, that equates to an average of $51,000. Negotiated price reduction up from $36,000 last year. While the industry hopes for lower mortgage rates in the second half of 2024, active sellers can only work with the current market as it is presently, which is challenging. Sellers, please don't overprice your home. This is not the time. Don't think that your home is more special than your neighbors just because you live in it. Inventory of homes for sale has been rising all year long. Our supply of homes for sale is 54% higher than June of last year, and the demand is less than June of last year. So do you think you should be overpricing your house? No, not if you really want to sell it. Seasonally, supply fluctuations level out in the summer before picking up again in September and October. The not so perfect houses, those that appear to have deferred maintenance issues, need excessive repairs, or simply don't show that well, those have the most trouble selling in this environment. With so many other houses to choose from, these homes may not even get a showing in many of the cities in the outskirts, regardless of how attractive the list price is. Buyers right now want move-in ready homes, fresh paint, clean homes, and they will walk away from something that is not up to par because there are a lot of houses to choose from. Even perfect listings are suffering from the buyer's unrealistic expectations in this market. While these homes may smell like fresh flowers and are well maintained and have updated beautiful finishes, those type of homes usually sell in any market. But right now, we really need to manage sellers' expectations because it may take a little longer to sell. As the market shifts abruptly from spring to summer, the median marketing time prior to contract has grown from a standard 3 to 4 weeks to 6 weeks, while experiencing at least one price reduction within that time frame. The average days on the market right now are 45 days, so about a month and a half, and we have about 90 days of supply, meaning if no new listings hit the market in the next 3 months, we will run out of houses to sell. 90 days of supply is considered a healthy, balanced market. Sellers haven't seen a supply-demand ratio like this since about 2014 or 2015, so 10 years ago. Managing expectations and patience will be key in navigating a successful sale if you're a seller. I hope this information was helpful, and I would love to hear from you, so comment below and like and follow and subscribe if you haven't already. Until next time.